Afternoon, viewers, and today we are proceeding with our series of financial management, and we are going to look at the cost of capital and capital structure, as we had agreed on. That we'll first look at how we get this discount rate or the required rate of return, and from there we shall be able to resume with how we can be able to discount the future inflows in order to know their present worth. And before we go there, let me try to give you the relevance. How is it relevant to know the cost of capital in terms of the investment management? Here we are looking at how the required rate of return helps us to find the profitable ventures that we should invest in our money. Here we are trying to look at, or we are trying to link the cost of capital to the investment decisions. And you know, from our main objective of the firm, we said we want to first get the money. When we get that money, we allocate that money into the ventures that can be able to provide the returns that will help the company to maximize the needs of the stakeholders. And here we are saying that if they ask you explain the relevance of cost of capital in investment management, here what we are trying to look at is how are they related with the cost of capital and the investment management. What we are trying to find is we want to get the required rate of return, and we try to compare it with whatever we shall be using, whichever method we shall be using, in net present value, payback period, and all of that, internal rate of return, and all of that as we shall see them. But for now, let's try to see the relevances. We are saying that crucial decisions in financial management are made with reference to the cost of capital. The reason why we are talking about the cost of capital here is the required rate of return. And we are saying that in the capital budgeting decision, the cost of capital is reflected in the investment, in the investor's required rate of return, RRR, which is then used to discount the investment's cash flows. Now we are talking about the cash inflows, so as to drive its net present worth, we are trying to look for that required rate of return that we can use to discount these future inflows into their net present worth as of now. Also, recall that the internal rate of return, that is the IRR, is compared with the required rate of return. These internal rate of return, the payback period, the net present value, all of that, those are some of the discounted methods. There are others which are non-discounted and others which are discounted. Like the payback period, for it is out, it doesn't consider much about this internal rate of return, sorry, the required rate of return. But this net present value, profitability index, and the internal rate of return, those are the discounted methods we use when we are evaluating the profitability of the business. So now we are talking about these methods. All of those methods, in the internal rate of return, we compare the internal rate of return and the required rate of return. We see if the investment is viable, then the internal rate of return must be more than the required rate of return, because the required rate of return, we said, is the minimum amount of money the investor is expecting when he puts in, or when they invest in long-term assets. And that's what we base on to compare the profitability of the business, whether to take up the project or to ignore. Because if it has a less, when it has the internal rate of return which is less than the required rate of return, we expect that that business is not going to be viable. And we shall see those computations. But for now, let's try to know that this cost of capital is related to investment. The other one is the profitability index also relates to the present value of inflows of the outflow. It relates to the present value of inflows to that of the outflows. Here, what we are talking about is that when you want to get the profitability index, you get the net present value of inflows over that of the initial outflow we are putting in the business. That's what we are looking at when you say that the profitability index. But all of those methods, we are going to look at each of them in details. But what I want you to pick from this is that they are related. The other one, they are saying in the financing decision, the finance manager also seeks to obtain for the firm a capital structure that minimizes its cost of capital. Why are we talking about this cost of capital? Is actually the cost we are incurring for the capital we are getting. So when you are looking at the capital structure, we are looking at that will have a least cost of capital. That's what we base on when you are looking at the capital structure, because we are trying to minimize the costs. In the same vein, the decision to appropriate the firm's earnings. Now we are talking about the dividend, the net profits, how we appropriate them into the retained earnings and the dividends we are giving to the shareholders, either as dividends or retained earnings. Or profit seeks to minimize the cost of capital for the firm, among other things. What we are basing on is, because to get that net profit, we have to get the revenue minus the cost. So if you have incurred high cost on capital, then we are expecting to be getting less net profit. So all of that, at least you have got something that can help us to push through to the next slide, which is going to be talking about the cost of capital. Now, when you are talking about the cost of capital, I'm going to give you something that is a bit brief, because we've been talking about this, and we are saying this is the minimum rate of return that a firm must, you get the word must, generate for an investment, must generate from an investment in order to justify the commitment of funds in such an investment. As I said, you base on that, because you can know, if you know that you have put in 10 million and the cost, the asset we've acquired, it will last for, let's say, 10 years. If you want to get how much is it every year, as in terms of the inflow, you just get the 10 million divided by 5. You just find that you'll be having 2 million. So if you see that it is 2 million every year that we are supposed to be receiving for the 5 years, then you can know that I can add something and it becomes a profit. Whatever goes above 2 million will be profit, will not be. That's what we are trying to look at. And we are saying here that it has the following. We can categorize that into the different. It is categorized into 4. one, we have the specific cost of capital, and this cost of capital is the required rate of return on an investment in a specific financial asset. When you're talking about the specific financial asset, we are talking about either the money we are getting through shares or the money we are getting from other sources other than the shares that are contributed by shareholders. It may be in terms of retained earnings. We had some retained earnings we've been accumulating. We had some money we borrowed from the bank and others. So here we are talking about the specific, meaning it is one category when you are computing. But the second one says overall. Overall means the total. That's what we call the weighted cost of capital. It is overall or weighted cost of capital. This recognizes the fact that a firm uses a pool of funds other than a single source. It is therefore the cost of capital for the aggregate fund used in the firm as opposed to the specific cost of capital, which is for a single source of fund. Here, what we are meaning is that we are looking at the total combination. You may find that in an organization, we have used debt and equity. We have got money from the shareholders or the owners of the business, and we have also added extra money from the borrowed loans or the loans from financial institutions. Then the third one, we have the historical cost of capital. As the word suggests, it is a historical meaning, which means that it was already incurred. It is the cost of capital that was already incurred. The cost of fund already been utilized in the business. We have already been utilized that money in the business. These funds were raised sometime in the past, making its cost historical. So if you have put in, if let's say last year we put in 10 million, but on top of that 10 million we put in, the money is still working within the organization. So when we go to the next financial year, we shall be having a balance that will be the capital that was contributed some time back. And we shall see how we compute all of those. Then the last one, we have the future or the marginal cost of capital. This future marginal cost of capital is, as the word you hear, it is suggest, and the word marginal means additional. So this is the capital we are hoping to add into the business. It is futuristic. It means that we are planning to put in other sources of capital, either from the debt or from the owners, or maybe we are expecting to issue out more shares to the public so that we can be able to raise more capital. They are saying that the cost of fund yet to be raised by the firm. It refers to the funds which are being planned for. It's determined by conditions relating to the future when these funds will be raised. Because it's a cost of additional funds to be raised in the future, it's referred to as marginal cost of capital or weighted cost of capital using the marketing weightings or the market weights. Here we are looking at, because we are expecting to get the money in the future, and we plan that we are going to be issuing lesser shares to the public, and we see the people who are going to be coming in and buy the shares so that we can be able to raise the money. Or we can just go direct and we plan that we get a loan, and that loan, we try to look at what will be the returns on that loan, what will be the interest that is going to be paid, and what will be the other costs that are associated with the loan we are borrowing. So those are some of the cost of capital, the categories, and we are going to look at each of them in detail in regards to the cost, sorry, in regards to the capital structure, what is contributed within the capital structure, and we try to look for the required rate of return, the IRR for each, sorry, the RRR for each source of fund that has been invested in the business. So here we are looking at the types of cost of capital. The cost of capital we have the cost of debt, as I said, that's the money we borrow from financial institutions or lenders. So what we want to find out, what will be the minimum rate that we are expecting to get if at all we borrow that money from the bank. This refers to the required rate of return on investment by the lenders of funds, what they expect to get from the business. It may be in terms of the interest, because when they compute the interest, you find that the interest is known, and they know how much they are going to be, because when you go to the bank, they just tell you the interest is going to be this. So how did they come up with that is what we are going to be seeing. And we get that percentage that we can apply on the amount we get, so that to our side, it is going to be that interest is going to be an expense to us, but for them, it will be an income. So we are saying the explicit cost of debt is the interest cost that a firm must incur to secure a debt fund from lenders. That interest we are going to be paying, it's what they call the explicit cost. It is what we are going to be paying to them. To us, it is going to be an expense, but to them it will be an income. This cost is obtained by determining the discount rate, that's KD. This is in a short, it is KD. Can try to make that one broad. So we are saying which equates to the present value P1, means present value of period 1. These are just period 1 of the debt to the present value of the interest the principal pays on the debt. What we are trying to look at is that when you are determining the discount rate, how are we going to convert? How are we converting that? It means that the present value for that amount that is going to be paid in that, let's say 1 year, it will be equaling to, it will be the same as the interest that principal, because when you get the principal, that's the amount they are giving you. But on top of what you are going to be paying, what you are going to be paying will be inclusive of the principal plus the interest. You'll be paying them at once. So when that happens, what we are trying to look at, how much will it be if at all we have discounted that and we try to look at it in its present worth. That's what we are going to be looking at here. And they are saying, generally, if PO, and this PO, it was given as the value of the debt. What they are saying, generally, if PO were the value of the debt or the principal we took as reflected in the price that the instrument would fetch on the market, then KD, the cost of capital, and the I, that is the coupon rate of interest, that is the interest rate, for the period, then the debt outstanding and the maturity period. Of course, when you're taking a loan, they give you there are things you have to first note. One is the interest that you are going to be paying. Having known that, you know how much you are borrowing, what are the costs that are associated with the loan, if they are processing fees and all that, other stamp duties and other charges that are charged. You get to know those ones. Then you know the period, when is the loan going to be complete. Then from there we can know our cost of debt, and we are saying our cost of debt will be the interest. We say this I is the interest, and it's going to be interest for the period 1 over this KD. And KD, we said it is the cost of debt. But we know how to calculate the KD, and the KD is calculated by the interest of the debt over the value of the debt, which means it is I over P. You can either go by this and you try to discount it, but for us, what we prefer is to get the percentage that we are going to be using. That will be our RRR. And in the case of perpetual debt, a perpetual debt means it's that debt which doesn't have the maturity period. We don't have the maturity period and we don't have the maturity value. It means if you don't have this MOV, then we are going to be using this. If in the question you are not given the maturity period, you are not given the maturity value, then we are going to be using the interest over the total. That will give us the cost of debt. But that also will happen if we have not been given the tax rate. But if you find in the question there is a tax rate, then we are supposed to use this. Having got the cost of debt, we put it, we make sure we get a tax component, we tax it. By taxing it, it is taking 1 minus T, because this KD is equaling to this, which is the interest of the debt over the value of the debt. Then we multiply by 1 minus T, and this T is our interest rate. This will get it when it is after tax. Whatever we are going, the cost of debt we are going to be getting, it will be after tax, but this one is before tax. If you are not given the tax rate, then you just proceed with this. But if you are given the tax rate, and to give you some idea, because most of the times the question may be silent and they don't give you the percentage, but as you know, companies, based on the taxation, the laws of Uganda, we charge 30%. That is the tax we charge to companies. So most of the times the tax is going to be 30%, because that's as per the law of Uganda. That's the income tax we charge, which is 30% to companies. And we are saying if you don't have the tax rate, then we go by this. If in the question you are given the maturity value that this loan is supposed to mature at this period, then you use this. This will be the interest. Then this KD, we know how to compute it, is the interest over if we were given the maturity period. But if they issued an irredeemable bond, then we expect that it is not going to be having a maturity period, and even the maturity value will not be there. Then we use this. This one is after tax. Hope you've known, but we are going to see how we can apply if at all we get to the practical question, because we are going to pick a question and we'll try to look at how we can determine each of those ones. The other one, this is just a continuation of the types of cost, because it is type of costs, cost of capital, continued, meaning it is just a continuation. The first one, we had the cost of debt, and we said It is the minimum that we can expect to get from the money we lend out. So here we have the cost of preferential shares. You know, from the preferential shares, for them, this is reflected in the rate of dividend the investor require in order to purchase these shares, what we are giving out to these preferential shareholders. And we are seeing that it is the minimum dividend that investors can earn if they are to invest in these shares. If they are buying these preferential shares, how much are we going to give them as in dividends they are going to be receiving? That's what we want, the minimum they can earn from the preferential shares. What happens is that when you are setting up this minimum, this is as per the management. We have, this is as per the company, and we set it up. It may not necessarily be the same that when you go to the shareholders, they may say, no, for us, we are not going to use that percentage, but rather we increase the percentage. But at least for you, you'll be knowing that if they invest in their money, that's what they expect to get from the shares they are buying. And we are saying, then the preference shares dividend is not a contractual obligation that the firm meets. It's normally fixed. You know, from that, even if I don't explain, but what I want you to pick is that this percentage is, most of the time it is fixed. If it is 10%, it is 10% throughout. If it is 20%, 20% throughout. So most of the times when you just find the percentage, you will see when they are giving these questions, they just say 10% preferential shares. It means you will get 10% of the value of the shares, then that will be our cost of preferential shares. And it is got by getting the preferential share dividend per share over the market price of the preferential shares. That's the formula for getting that. And the next one is cost of debt or ordinary shares. When you are computing this cost of equity, sorry, it is cost of equity or ordinary share capital. This cost of equity is most of the times equal to that of the retained earnings, because this is equity, the money that has been contributed by the shareholders. This is the ordinary share capital. This refers to the dividends that investors receive or require in order to invest in these ordinary shares. The determination is more complicated because the dividends on ordinary share capital are not definite. If something is not definite, it means it is at infinite. Why are we saying it is at infinite? Because it is always there in the business, so long as the business is still operating. These people, they are going to be getting everything until the lifespan of the business. They fluctuate depending on the available earnings and the priorities of the board of directors. What happens is that you are not the one to decide that you are going to be giving me this. It is the management that sits and says, as per the net profit we've got in the operations, let's give these shareholders 10% of what we've contributed. Because the reason why they do that is because they want to remain with some money that they can use to generate more income and finance the other operating expenses that may accrue during the next production. So since it is at infinity, we base on what the board of directors have suggested, and we take into consideration which percentage they are going to be giving to the shareholders, and they see which portion are they going to remain with. So you are seeing that this money is actually coming from the money they contributed, but when we are paying them, we pay them according to what the company or what the profits we've generated for that period. So here, you just know that retained earnings and the cost of equity, they will be having the same computations. The computation of the cost of equity will be equal to that of retained earnings, as we shall see them. We are seeing that since it is at infinity, we are getting the dividends over the cost of equity. These ones we are seeing, this is this I, we are saying it is the time period ranging from period 1 to infinity, since they are held forever as long as the business exists. This I, we said it is the period, and KE is the cost of equity being bought, and D1 is the dividend per share expected in period 1, because we are saying it is D1, but if it is D2, then that will be the dividend per share expected in the period 2 until the lifetime of the business. Hope you can be able to get these differences with the cost of equity and the cost of preference shares. For the cost of preference shares, it is 10%. It is known. It is not changing. You are supposed to give them that every, let's say, depending on how you've agreed, if it is for year, then they are supposed to get that percentage for that year. Even when it comes to paying, you first pay those people, those who have preferential shares, then we pay next these other ones, which we just base on whatever we have, the disposable we have, and we see how much we can be able to offer to them. Then we can look at the other one, and we said it is the weighted stroke marginal, or sorry, weighted marginal stroke future cost of capital. This is the cost of fund that the firm intends to employ. This is what we plan to employ in the production. As we said, this is futuristic. It's something we are planning to incur in the business. It's more relevant in evaluating new investment whose financing is yet to be procured. This may be for these other projects that we want to finance, and we are trying to look at how we are going to be getting that source of income. How is it going to be? Is it going to be debt to equity? Is it going to be equity only or debt only? That is determined depending on what amount that is available and what you want to do with the money. The process of determining marginal cost of capital is the same as that of historical weighted cost of capital, except that the weight used in the case of marginal cost are the expected proportions. Expected means they are not exact, they are not the actual ones. They are just assumed. Expected proportions of the new funds and the specific costs related to these new funds. Because you have not yet, since you have not yet got that money, you are assuming that maybe we are going to be incurring this cost when we are borrowing. Because when you are getting some money in the bank, there are some procedures, process fees, there are some costs you incur, stamp duties, and all other costs. We accumulate them and we make sure these are the borrowing costs which are supposed to be added back to whatever construction we are, or whatever project we are going to be doing, and becomes the capital. We capitalize it. Then the last one is the weighted marginal cost of capital. Here we are going to look at it and we see how we can be able to estimate the cost of equity, the cost of debt, and others. But I'm going to look at it, and we are going to be having a question that is going to come from this when you're computing the weighted marginal cost of capital, and the other one, which is the one for the average. Here we have two ways when you're estimating the cost of equity and the cost of debt. One, we can apply the dividend growth. When you have the dividend growth rate, they give you a growth rate, and you see how we can be able to apply to the cost of either equity or debt, and you know how to get the required rate of return. We are saying that a company's cost of equity can be measured by dividend evaluation method. The model, this is just a mode, and this mode assumes that the market value of shares is directly related to the company's expected future dividends on shares. What do I mean by that? Because these assets we have not, sorry, these shares we have not yet got them from. We've not yet got them because we're just planning them. We are planning to get them. So by the time we get them, what we assume, because we assume what we can assume, but remember it is the market to say that we are buying this and we are going to be paying this depending on the number of shares that are going to be allocated or allotted. And when we are done with that, then we expect that we are going to be getting this money, and what we expected may be equaling to what will come from the market. And we are saying the model is premised on the fundamental theory of valuation, which states that the value of an asset should be equal to the present value of its future inflows. What does this mean? If you buy an asset 10 million, we expect that the money you are going to be getting every year, if that asset is going to last, let's say, for 5 years, should be able to cater for the cost of the asset we purchased. That's the valuation they are talking about, that the value of an asset should be equal to the present value of its future cash inflows. Then they are saying that the market value of the company's shares would therefore be equal to the present value of its future dividends. The whole of that is just a theoretical aspect, but what I need you to get is how we compute this when we have the growth rate. When you have the growth rate, it will be the future dividend in period, that, let's say, period 1 or period 2 over the market value of the equity shares. Then we add the growth rate. It's how the dividend is going to be growing in a certain period of time. It may be specified that it is 10% per annum, or depending on which period. This is what we are supposed to pick. And when you get this, you can be able to compute the cost of capital or the required rate of return that we are supposed to be getting from that. Now this part B is when we compute the cost of debt. Remember, the other side we've been computing the cost of equity. And we said the cost of equity is the same as the cost of retained earnings. We are saying that the cost of debt, including preferential shares, redeemable, irredeemable, and convertible debts, all of them we are going to combine them at once, and we give it a formula here. Our concern is about the formula. What changes, what makes this one different from the other one is the flotation cost. And these flotation costs, those are the costs we've been talking about. If let's say you are going to take a loan, there are other costs you are going to be incurring that are related to the loan you are taking. Those costs, we try to look at them and we try to come up to them, and we make sure when we are getting the money, we remove it. That's why here you are seeing it is the cost of, this is the dividend per share that we expected over the market value, that is the market price per share. Then we less 1 minus the flotation costs plus the growth rate for that, the growth rate for the dividends. So we are saying here it is normally easier and more realistic to estimate the dividend for the individual year, and then assume that these dividends will grow at a given rate. How they determine these rates, the growth rate, it depends on how they have analyzed, they have made analysis of the money they are going to borrow and how they are going to be getting the returns in terms of employing the money they have borrowed. Here, what we are only interested in is getting the cost, what will be the minimum that we expect to get from the investment of the money we are borrowing. They are saying that dividends are normally assumed to grow at a constant rate over the future period. Here they're just giving you how they get this growth rate, but this is just an assumption because they assume that the rate is going to be growing at the same, the dividend is going to be, but it may not, because at the end of the day, you find that there are some other factors that may change and they try to reduce or increase the debt depending. Maybe you may find that inflation has increased and money has lost value, so they have to increase in something. There are so many factors that they depend on. Because what I want you to get is this. This is just talking about the costs that are incurred within the stamp duties, as I've been telling you, the legal fees, stamp duties, and others that are within the cost within borrowing. So what we have to get into our memories is the formula. It is the dividend per share for that period you are computing. If it is for only 1 year, if they have not given you the periods, then, but all of these information is supposed to be given in the question. If the flotation cost is not given, then you just note it wasn't there. So we are looking at the weighted average cost of capital. The other time we were looking at the weighted marginal. Marginal was just the additional capital we wish to put into the business. But this one, we are looking at the weighted average cost of capital. Let's try to get the sum. What are some of the differences? What makes it different from the average and the marginal cost of capital? The weighted average cost of capital is the firm's overall cost of capital. I'm repeating. Weighted average cost of capital is the overall cost of capital. Why? What do we mean by by that is when you get the average. Of course, to compute these costs, you get each specific cost and you multiply by the weights, as we are going to see how they weigh these, because we are going to see the steps of how we compute each of these. When we get that, then we get the total, we sum them up. This weighted becomes the cumulative figure we are going to get after multiplying the specific cost of capital and the weights. It's obtained by aggregating the cost of all individual sources of funds into a single cost of capital for the firm. You've seen we are just aggregating the cost of all the individual sources of funds into a single cost of capital. And when you combine all of that, just know even the whole total figure of the capital structure, we have combined it and we know how much we are expecting to get out of that whole amount we've acquired in the business. The use of the overall cost of capital is important because when the firm finances its investment, it uses a pool of funds, and the relevant rate of return to be required should be that related to this pool instead of the cost of individual item. Since we are using, when you're putting in the money or when you're buying these assets, we use different money from different sources. So we combine and we get one required rate of return that we are going to be using on such investment. The reason why we are combining is because we are using different amount or different sources that contributed to the capital we used to buy those assets. But if we are, let's say, using money from the owners of the business, we could just use only one specific cost of capital and we call it our required rate of return. But since we are using a cumulative source of the resources, then we are supposed to put all the specific or the individual cost of capital together and we come up with only one that can help us to know how much we are supposed to get from that investment. That's how we get that. And we are saying the weighted average cost of capital can either be that already existing funds. It can be either that of the existing firm or the one we are going to be getting as in terms of the margin. It also referred to as the historical average cost of capital because it uses derivative proportions of book value of existing sources of fund in the business. We are going to see the computations. From the theoretical aspect, you may not pick it right, but when you got the computations, you are going to understand each and everything. So this is where I want you to focus. This is where I want you to focus all, because this is what is going to help us compute the weighted average cost of capital. These are the steps we follow when you are computing the weighted average cost of capital. And the reason why you are computing it is because when you are purchasing assets, we use money from different sources. So we have to accumulate and we come up with one. Remember, each specific cost of capital contributes its own required rate of return, but we want to get one RRR that can be used when you are valuing the assets we've acquired using different sources of income. The first step is to determine the specific cost of capital. You cannot just get, if let's say the capital structure was 100 million and 100 million has 20 million from debts 30 million from retained earnings, 20 million from bonds, let's say 2 million from, let's say, owners. You get, it is a cumulative figure, but you have to break it and you get it, each component will give it its own cost of capital, or the RR, the required rate of return. We are saying determine the specific cost of capital for different categories of funds used in financing by the firm, what we used in financing those activities. Secondly, we determine the weights. How do we get these weights? These weights, it's like the way I told you that if you contributed 10 million, if let's say we had the capital of the overall capital of 100 million, but within the 100 million, we got 50 million from equity or from the shareholders, and we got 20 million from debt. We borrowed some 20 million, and we had retained earnings, let's say 30 million. What if you want to get what is the proportion of each to the total? Because it will be the cost of debt over the total, that times 100, it will give us the percentage or the proportion of what each item contributed to the total pool. And that total pool was making us, that was making 100 million. And that 100 million, if let's say the cost, as we said, the cost of debt was 50 million, then it will be 50 over 100 million. We can convert it to 100 and multiply it to 100, and we get the answer we get will be used as our weights. When we've got that, then we just multiply. We multiply the specific cost of capital, we multiply by the weights. When you multiply by the weights, then what we get as the result of the multiplication of the two, we add them. We add all the components, the one from equity, the one from retained earnings, and the one from debt. Whatever we shall be getting will now be called the overall cost of capital. And that overall cost of capital is the one that we are going to be using in investment decision when we are appraising the projects, when we are trying to find out whether the projects we are talking about, they are viable. And we only do that when we have used different sources of capital. If we just use the money from equity, then we expect that the overall is going to be that specific item. Hope you can be able to understand that. And we are saying that the overall cost of capital is equal to the sum. This is the summation of WI. These are just weights, and the cost of the specific cost of capital for each source. Then when you sum up, whatever we get will be called our required rate of return, and that will be the company's required rate of return, because that cost of capital came from the sources that the sources that contributed to the money we are using in the business. So it becomes the company's overall required rate of return. So whatever we shall be doing, when especially we are discounting, we compare everything on that required rate of return. That's why from the beginning, we are comparing that the internal rate of return is compared with the required rate of return to give, hope it was this where we were computing that the internal rate of return, it was here when we are saying that the internal rate of return is compared with the required rate of return. I hope you've now known how we compute the required rate of return that we are going to be using in every topic that we are going to be talking about if it is requiring on the investment or the capital budgeting decision. And when we have done with that, then we can be able to proceed to other topics like working capital management, where we look at how the cash is managed within the organization. Thank you for watching, and God bless you.